بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to lecture 4, Payout Policy. So we will learn about the policy, like how the company decide whether to pay dividends or cash to shareholders or not. So from the name, we call it payout. So the company is going to pay money outside for shareholders, and there is a policy. Like every company has a specific policy. So inshallah we'll discuss the payout policy. So let's start. Firms can pay cash to shareholders in two major ways. The first one called cash dividends or share repurchases. So we have two ways. That the company at the end of the year have enough profit and they want to pay for shareholders. They can pay it as cash. We call it cash distributions or cash dividends. Or there is another way called share repurchases. We will discuss this through this lecture, inshallah. We will start with this graph, how corporations pay cash to shareholders. As I said, there is two ways. First one, you pay dividends to them, or instead of paying dividends or cash to shareholders, you can repurchase the share from the market. So in real life, many companies, if they have enough money, they go in the market, they purchase their shares. They purchase their shares again from the market. So the idea, if you have enough cash, one way for the company, if they don't have any investment, they can buy their shares from the market. Then the price, of course, of the shares will go up. There will be a shortage in the market, right? Not enough shares, so the price will go up. And this graph shows that whether the company used dividends or stock repurchase. This is for United States from 1980 to 2008. So you can see the yellow one is dividends. Like at early 1980, there was only dividends. Then over time, we had more repurchase, the green. So over time, we are seeing now companies, they repurchase their own shares instead of paying dividends, or like they have dividends and have repurchase. Okay, let's start first of all with paying dividends. Then later on, inshallah, we will talk about stock repurchase. Paying dividends, there is two types of dividends. Focus with me. Now, for dividends, we are focusing on here on dividends. There is two types. The first one, cash dividends, and the other one is stock dividends or split. Cash dividends, this is easy, like payment of cash by a firm to its shareholders. Like for example, if you have, let's say, 100 shares in one of the company, if you have some shares, they will give you extra cash. So they make announcement at the end of the year. Everyone have a share. We will give, for example, $1. If you have 100 share, it means you will receive $100. If you have 1 million shares, you will receive 1 million dividends. Okay, so the company every year they announce something called regular dividends. So this is a regular. Every year they announce it. Okay, and the amount depend on the company. Okay, if they have high profit, they will pay more. Another type of dividends called also special dividends. So this will be only one or two times special, like from the name. Let's say if the company this year they have a good performance and they decide to distribute this one, they call it special. So they may not distribute this one the next year or the year after. This is special. However, the regular is every year you will receive dividends. So this one we call it cash. Another way, and instead of paying money to shareholders, you can give them stock. You offer them more stocks. Like for example, if you have one stock, you will receive another one. Or if you have 5 stocks, you receive one. Depends, like there is many cases, okay? Normally, if you have more like 3 or more shares, for every 3 shares, you will receive 1 new shares and so on. So this is distributions of additional shares to firm stockholders. And this is actually a good way to pay dividends. So instead of paying cash, keep the cash in the company and give the shareholders more shares. Like for example, if you own a 3, you receive 1 extra. If you have 6, you're receiving 2, and so on. So this is two types: stock dividends, or sometimes they do stock split. So they split the stock into more shares. Like for example, if you have 1 shares, they will say for everyone who have 1 shares, we will consider it 2 shares. So we will divide it into 2 shares. Or we will consider it 1.5 shares, which means if you have 3, you receive 1 extra, and so on. We have an example in the next slide, which is this one. Imagine corporations currently has 10 million shares outstanding. So how many shares they have in the market? They have only 10 million, selling at 60 per share each, okay? The price of each share is $60, but the company, they announced the 3-for-2 stock split. This is how they write it, 3-for-2. The question is, after the split, after they divide, how many shares will be in the market? So before this announcement, there was 10 million shares. After the announcement, after they announce the split or the division, what will happen? Simply, this is a formula. You multiply the number of shares currently in the market, multiply by 3-for-2. You divide 3, divide it by 2, and this will give you 15 million. So after they divide the stock into more stocks, there will be 50 million shares in the market. So we know after the split, we will have 50 million shares in the market. Think on it like this. Like every shares, it become 1.5 shares. 3 divided by 2 is 1.5, right? Okay, every shares will be 1.5. If you have 10 million, this will be 50 million after you increase the half, after the split. The next question is, what will be the new share price? Now, we know every stock is divided into 1.5, but does this will affect the price? Yes, the price before it was 60. You divide it by 3 and 2, the price now is 40. So what the idea here? Number of shares increases in the market, but the price is decreases because it divided by the split. Okay, this is how we do the calculations. Let's talk about the key dates in the dividends. So there is some specific dates. This is famous dates when they pay dividends. The first one called declaration date. So from the name, declarations or announcement date. So the company announced we are going to pay dividends. Let's take this example. Assume this company on May 6, 2010, they announced we will pay 33 cents for every share. We call this day declarations date. Okay. They will go in the media and they will announce, or they will just announce as report, they will announce we will pay. This is we call it declarations. After a specific period, let's say May 26, we will call it ex dividend date. Okay, what does this mean? This means from now on, anyone who is owing the share will not receive dividends. However, the previous owner will receive it, which is actually important. Like when we announce we are going to pay dividends, we need to determine one day and we'll say at that day, if you are the owner of the stock, you will not receive anything. The previous owner will receive it. And why is that? Because we know the financial market, we have millions of shares for the companies. And we know everyone is buying and selling. Buy, sell, buy, sell. So how do we know to whom we should pay the dividends? So we need to put a due date. And that date or that due date is the last date you need to hold the stock. So if you want to receive the dividends, you hold it till that day. If you buy it at the X date, you don't receive anything. you need to buy it before. So here, when they announce this, the X date, okay, so you should before this date own the stock. If you own it after this date, you miss the payment. We call it X date. Then after that, the dividends will be paid to shareholders. Okay, and then you receive the payment date in your bank account after a specific date. Because we have many shares in the market, right? Every one is buying and selling every second. We need to know to whom we should pay, right? We put a due date, as I said. Then, as I said, you receive the payment if you are the owner before the due date, right? But if you are the owner after, you don't receive the dividends. You will receive it next year. Okay? The question is, what would you expect to happen to the price of a share of a stock on the day it goes ex-dividend? So, what will happen to the price of the share here? It will fall at the state. Why? Think on it. If I am the investor and I want to buy the shares from you in that day, I will buy it at lower price. Why? Because I know I am not going to receive the dividends. You are going to receive it. The old owner will receive it. So always the price at this date will go down. The price should decrease by the amount of dividends, and the reduction will be equal to the amount of dividends. Okay? Okay, we have one example here. It is tricky, but focus with me. Imagine a firm has 100,000 shares outstanding. This is number of shares in the market, 100,000. Each of them, or the total worth for them, 1 million. So if you have 100 shares and the value for those shares is 1 million, it's like each of them is what? It's like each of them $10. So you multiply 100 by 10, it's 1 million. If the firm issues a $1 per share cash dividends, now let's say the company they announce we will pay dividends equal to $1. The questions, how is shareholder wealth affected? We will not focus on the wealth of shareholders. Again, you need to do before and after. Before the dividends, now assume those numbers in the first box are given from the textbooks, okay? In the slide front of you. Assume the company before we pay the dividends. There was cash in the company equal to 150,000, and there was also other assets in the company equal 850. So the total will be 1 million. This is the value of the company before we issue dividends. How many shares outstanding? We said here we have 100,000. Now, if I want to distribute the value of the company, because I assume like this is cash and other assets, if you want to distribute it in all shares, you divide them. 1 million divided by 100. It means the price of each shares is $10. This is before dividends, okay? Before. Now, what will happen after the dividends? Remember, we want to pay $1 for each share. How many shares we have? 100. It means we need here $100,000 to pay for shareholders. We will pay it from our cash because it was 150. Remove 100,000, we pay it in dividends. The remaining will be 50 here, right? Okay, assets. Nothing happened to the assets. So the total value will be 900,000, right? Not 1 million, 900. Why? We already paid 100,000 as dividends. So we lost the money, we paid it. Numbers of shares is still in the market the same, we have 100,000. In this case, the price per share will be lower if you divide 900,000 by 100,000. Similar to the calculation in the first box. This will equal to $9. So you can see after the cash dividends, after we paid dividends, to shareholders, the market value of the firm falls to 900,000. And we saw it in the second box because we lost some money in the dividends, right? And shareholders, when we say we paid 100,000, it means shareholders. They receive 100,000 in cash, but actually their shares price reduced to 9. Okay, always after the dividends, the share price will go down. So this is just an example. Okay, we are done with the dividends. Now let's move to stock repurchase. Stock repurchases means when a firm buy back stock from its shareholders. So as I said, if the company have enough money or if they believe the stock price is very low, so what they will do, they will use the money that they have to buy the stock from the investor. They will buy their own stock. Definitely, when they buy their own stock, the price of the stock will go up because we will have less amount or less number of shares in the market, right? And it is again, at the end, this is demand and supply. When you have less shares in the market, the price will go up. When you have less tomato in the market, the price will go up, right? Now, how they do it? There is 4 ways to do it. The first one called open market repurchase. So from the name open market, it means the company will go in the market and buy the shares using the stock exchange. So they will buy directly from the shareholders. They will go in the system and buy shares, similar to any investor who wants to buy. This is the first one. And this is the most famous one. Normally, the company, they buy their shares from the market. Another way called tender offer. So in this case, the company or the firms offers to buy back a stated numbers of shares at a fixed price. So here they announced, we want to buy a specific amount of shares and they put the price. Like for example, they can say, we want to buy 1 million from our shares from the market and we are happy to pay $20 for each share. They will just announce it. Okay? Then all visitor and shareholders like me and you, if we are happy with the price, we will sell our shares to them. They call tender offer. So they offer you something. Then if you are happy, you contact them. You are not happy, you ignore them. Other visitors will contact them. Okay. Number 3, auctions. So from the name, the firm states a range of a price, not just the price. They will put many prices at which they are happy to purchase. So they will say, for example, we are happy to buy 10,000 shares at the price of $16. At the same time, we are happy to buy 100 shares if someone have 100 shares. Want to sell it? We are happy to pay more, which is 17, and so on. It's like an auctions, okay? So they put the price and people who are happy in visitors or shareholders who are happy with the price, they will contact the firms and sell it to them, right? So the difference between the tender offers and auctions, the tender offers is fixed price and an auction is not fixed. Okay, the last one, direct negotiations. The firm may negotiate the purchase of a block of shares from a major shareholders. So here they agree to buy a block, too much shares, a large amount of shares from a major shareholders. We know the shareholders could be another company. For example, if one company has 2 million shares in other company, they invest in the other company 2 million shares. So if they want to repurchase, they will approach the company and ask them to sell their shares. Okay? Also, like we have sometimes big families who buy a big amount of shares. One way for the companies to repurchase the shares is to approach the family and ask them to sell their ownership or their shares in the company. Okay? Here we have example similar to the example we did for dividends, but this is for a stock repurchase. Imagine a firm that has 100,000 shares outstanding worth 1 million. If the firm decide to buy back 10,000 shares at $10, so the company they decide to buy their own shares. how much they want to buy. 10,000 shares, and they are happy to pay $10 for each. Now, the normal question is how this affects the wealth of the shareholders. Again, you need to do it before and after. Before, we have this box from the previous slide. Nothing changed before. It's before. This is before dividends or before repurchase. The value of the company was 1 million and the value per share is $10. After repurchase, it means they want to repurchase 10,000 shares, each of them 10. It means they need money. How much? 100,000. So their cash in the second box will reduce by 100,000. Okay? So we have value of shares, $900. Now, the only difference here from the previous example, number of shares outstanding in the market is lower because the company, they already repurchased their own shares. They repurchased 10,000. So the remaining in the market, we will have 90,000 shares. Now, when you do the calculations, the price will be 10. No change here. If you go to the dividend, for example, this was 9. Okay, this was 9 because we were dividing by 100,000. Here we are dividing only by 90, right? We already bought 10,000 shares from the stock. So what is the effect? After the stock repurchases, the market value of the firm falls. We know this is 900. Yet shareholders returned equal ownership. So there is no effect for their ownership in the company. It was $10 per price. Again, it's $10 per price. That's why now most of the companies, they move to stock repurchase because this will keep the ownership of shareholders the same. Okay, after the repurchases, shareholders can sell 10% of their shares, earn 100,000, yet they will retain the ownership, equal ownership, which we provided in the previous example. So now the shareholders' position is exactly the same with the share purchase as with the cash dividends. Okay, now we have total shares 900 and they received 100,000. Now let's talk about share valuations. So we are done with the dividends, we are done with the stock repurchase. We have one example on each. Now let's talk about the valuation. How we evaluate the shares. How we know how much to buy in these shares or what is the maximum price I pay in the specific shares. Only one share. Okay, the dividend discount model taught us that the price of shares is equal to what? Is equal to the present value of all future cash flows. So always the price of the shares will equal the present value of all future cash flows from the shares. And we learned this one from another unit, right? Finance 101, Principal Finance. Now, the question is, what if the dividends, it was repurchase, not cash dividends? So before we were laying on dividends, we were discounting the dividends to calculate the present value. But if we don't have dividends, if they use repurchase, how to calculate? We will see this in the next example, inshallah, which is here. A firm promised to pay dividends of 100,000 in perpetuity with 100,000 outstanding. So what do we have here? The firm, they promised to pay. How much? They want to pay $100,000 forever as a dividend. And how many shares they have? 100,000 shares. Now, what does this mean? This means every share will receive $1. They will distribute 100,000 for 100,000 shares. Each share will receive $1 dividends. Assume discount rate 11.2. And the question is, what is the present value of one of the firm's shares? We want to calculate the present value of the shares. Now, there is a formula for this. Always the present value of the shares in perpetuity is equal to the amount of dividends divided by the discount rate. The amount of dividends is not mentioned here, but as I said, If they want to pay 100 for 100 shares, it's like each of them will receive 1 shares. So this is the amount of dividends per share. Each share will receive $1 divided by the discount. This is a formula for perpetuity. This will give you $9. So this means the maximums I pay in these shares is $9. Okay. So if they ask me to buy these shares, I will say maximum I will pay $9. So this is a present value of all future benefits. Now this is case one. In case they distribute cash dividends, easy to calculate cash dividends. You divide two numbers. Okay. Okay, let's read this example. Same firms decide instead to use the firm's year's proposed dividends of $100,000 to repurchase. Imagine now they want to, instead of distributing cash, they want to repurchase 10,000 shares in year one. In year two, it will resume annual dividends of 100,000, but in year two, they will go back again to the dividends. What effect does this have on the value of the shares? So in the first year, they want to repurchase. The second years, they want to go back again to dividends. Now, let's start with the dividends, the second years, because this is actually easier because we know the first calculation from the previous part, yes? So it is similar to it. Now, how many dividends they are going to distribute? 100,000 in year two, right? This mentioned in the questions. So I need to see how many shares in the market. Now they will have less numbers of shares in the market because they repurchase 10,000. Originally, uh, 3 was 100,000 shares in the market, which is mentioned in the questions here in this example, right? Okay, if they decide to repurchase 10,000, the remaining will be 90. Okay, we put it in the denominator. So now they want to distribute 100,000. They want to distribute it into how many shares? In only 90,000 shares because they bought the other 10, right? Here you will receive $1.11 dividends. Exactly similar to this one, okay? This was 100,000 divided by 100,000 shares, right? Now we have less shares, 90,000. So 1.11. Now, the second step, we will follow the previous example. As I said, similar to the second step here, so you divide these two numbers, whatever you get from the first answers, you divide it by a cost. Okay, so 1.11 from the first steps divided by cost of financing. I will call it A to be clear to you, okay? This will give you a value or an answer or a result, but this is actually not the final answers. Why? Because we are here in year two, not year one, right? So here, like when you do this one at the top, it's like you calculate the value, but at year two. However, I am interested today how much to be in these shares. You divide it again by 1 plus R. This is the formula. So you will actually will do it in two stages. Actually, here is do it in three steps. First, find the dividends. Step number two, divide whatever you find as an answer by the R. Okay, similar to what we did here. Then after that, it will give you actually step number three. Then the answer from this step, you need to put it in the top in the numerator. This is A. You divide it again by 1 plus R. This is the formula always. So you can see it at the end. We will have $9. Okay. Let's move. Now we will talk about dividends. Different firms, they have different policy. So this is like questions here. They do a survey. They ask all the managers how you use the dividends, and the answers are here. In general, dividends are surprisingly smooth annually, and managers are often reluctant to alter them. So the result of this survey was most likely always dividends. They smooth it. They try to make it consist every year. And all those managers, they feel reluctant to cut them or to reduce the dividends. So they would ask, is smoothing very dangerous? We should not play it as a financial manager. Why? Actually, it is in the next slide. Because of the information signaling. Dividends and repurchases provide clues about the company true financial prospects. So when the company distributes dividends or buy their own shares, this will give some signal to me as a shareholder whether the company is good or not. Okay, so dividends increases in general if there is an increase in dividends. This sends good news about the future cash flow of the company. So if the company, for example, this year's dividends was $1, at the next year, if they increases to $2, this is a good sign. It means they are confident. They are getting more cash and they want to distribute it. Dividend cuts, definitely this will send bad news to the market. So as a financial manager, you need to be careful not to play with the dividends. You even don't cut the dividends. And some research, they said some companies, they take loan. Imagine, they take loans just to pay dividends. Because if they cut the dividends, this will send some bad information to the market. If management announces an expected cut in dividend payments, what do you predict will happen to the share price? Share price will fall. Okay? Everyone will sell the stock because they know there is something wrong with the company. So was just the general introduction. Dividend is sending some information to the market, but we have some controversy here. What is the effect of a change in dividend payout policy given a firm current capital budgeting and borrowing decisions? Now, sometimes companies cut the dividends, but they cut it for a good reason. For example, they want to use the money to invest in more projects. They have more opportunity. Why they want to distribute it? They don't want to distribute the money. They will invest it in many projects. Then the stock price will go even up, and shareholders will be happy also, right? So there is another explanation. So firm may be low dividends due to optimistic future growth perspective. If they fall, there is a good project. They cut the dividends and they invest it. This payout decision is a byproduct of the capital budgeting decision. So capital budgeting decisions here affect the dividends decisions. And I think many technical firms, they normally grow quickly, like Instagram, Facebook, Twitter, those things. So they invest more money in the growth of the company rather than distributing cash dividends. Firms may finance expenditure by borrowing, thus freeing up more capital to be paid out to shareholders. Sometimes they borrow more to invest in order to free up some capital to shareholders. So, what is the idea here? The idea that dividends policy is not an easy thing. It always involves a trade-off between higher or lower cash dividends and issue of repurchase stock. And there is no one single theory. Every firm will have their own policy. Now, the questions, are dividends irrelevant? Now, let's go back again to M&M. Dividends policy does not affect the firm value under the assumptions of perfect financial market. So they assume here we have a perfect financial market under these assumptions. Then the value of the firm is unaffected by dividends policy. So whether you distributed cash or not, whether you cut dividends, this will not affect the value of the company. This is how they argue. And here we have one example. A firm plans to pay annual dividends of $5 per shares in perpetuity. So this firm, they want to buy $5 cash dividends forever. And shareholders expected 8% return. Assume 1 million shares outstanding. By the way, share outstanding means that number of shares the company has issued to the shareholder, and these shares are out there in the market. Okay, Let's say we have 1 million shares in the market. What are the total dividends paid each year and what is the percent of each of them? Two questions. Total dividends paid. It's easy. I wrote the formula for you. Total dividends paid is how much dividends per share multiplied by the number of shares. Okay, so they want to pay how much? They want to pay $5 dividends. And how many shares we have in the market? 1 million. So $5 multiplied by 1 million. They are going to pay $5 million as dividends. The next questions, we need the present value. Always the present value, as we learned before, it's equal to what? It's equal to the amount of dividends divided by R, or the interest rate. And this will give you 62.5. So this is in case 1. Okay? They want to distribute cash dividends. In case 2, in an attempt to increase the share value, this firm plans to pay annual dividends $10 per share in perpetuity. And still, shareholders expect 8%. Now, similar, the same as the previous example. But here they want to pay $10 dividends instead of 5. Assume now we have 1 million shares in the market, and what is the present value of each share? Let's calculate first how much they are going to distribute. $10 per share multiplied by 1 million. It will be $10 million. Now, this note in the slide from the textbooks. Assume now we said they want to pay here how many dividends? 10 million. In the previous case, it was 5 because it was $5 in the questions, right? Okay. Now, this is actually double. It's 10. Okay? It was 5, but now it is 10. Now assume the other 5, they will pay it. They want to replace the lost cash in a new share of issue of shares. Now, because the company, they pay extra dividends here, they need money. How are they going to finance this? They will issue shares to shareholders to take money, then pay it as dividends. So again, the firm must replace the lost cash with the new issue shares to earn the same profit in future. That it will need additional 5 million so that it can still pay the dividends. Okay? This is just one scenario. Now, try just understand this example. So the company must now pay additional $400,000 per year in a dividend to the new shareholders. What does this mean? So how did we calculate the 400,000 here? 5 million additional multiplied by 8% is 400,000, okay? Now focus with me. We need to pay additional 5 million in shares, okay? Based on the current profits and everything, company, it was saying that it was able to pay $5 per share earlier. Now, if it wants to give a dividend of $10 per share, that means it will need additional 5 million money, correct? Okay. Then it will raise 5 million. So what we're saying here is that company needs to pay a total of 10 million. Now company only has 5 million money in the bucket. So they will need more 5. But like in that, also they will have to give the dividends to people. So on 10, they already giving 10 million. And when they take 5 million from the people, it would also have to give 8% on that, which is 400,000, right? Okay. So again, company has to give 10 million total dividends, right? And the company has money, 5 millions. So additional money required 10 million minus 5 million, it will be 5 million, right? Now, on this 5 million, the company has to pay a dividend also to this 5, right? It is at the cost of raising money. If you're raising some money from the shareholders, the new shareholders will demand money. They will also demand the dividend, right? Additional dividend to shareholders is equal to 400,000, which is 5 million additional multiplied by 8% is 400,000. Now, to understand with me, In the first year, company is paying 10 million, right? And it will not give 10 million forever. See, the question is simple. Okay, it's like saying that the business is as it is. There is no change in profit. In the future, companies will generate 5 million per share, 5 million profit total every year, okay? Just because if you change the dividends in the first year to $10 per share, like it will not change the value of the shares today. Now, how much dividend will have to give an additional 400,000? As long as the company replaces the extra cash it's paying out, it will earn the same profits and payout. So 5 million of each year from year 2, 400,000 of this will be used to satisfy new shareholders. Okay? So the company will still generate some profit of 5 million out of the 5 million from the next year onward. It will have to pay an additional 400,000 to the new shareholders, as I said. So what is the remaining amount which the company will have for the existing shareholders? 5 million minus 400,000 is 4.6, correct? Because if you are giving 10 today, from next year onwards, you will have to give 4.6, right? Because 400,000 will go to existing shareholders, like the new shareholders. Then how much money will be remaining for the existing one? 5 million minus 400,000, it is 4.6 million. So 4.6 million divided by 1 million is $4.6 per shares, okay? So that will go up to perpetuity, like forever, because we have raised money. Now we have raised additional 5 million. That means every year we have to give 400,000 to the new shareholders. So for calculating the present value, what we will do simply, we will do the present value of the dividends paid next year at the end of the current year. 10 divided by 1.08 plus 4.6 divided by 1.08, and it will go on like this 3, 4, 5, 6, 10, 20 forever up to infinity. Okay, you remember the formula for doing the perpetuity one, which we did, the dividend per share divided by rate. Okay, like is so earlier when it was $5 per share up to perpetuity. How are we doing the calculations? 5 divided by 0.08, right? And it was 62.5. Okay. Now, what is the change in this example? In this example, the dividend per share is now 4.6 divided by 8% is the value of the shares. In the first year, it will give a dividend of 10. So the value of dividends at the end of the first year, the future value at the end of the first year is $10. Okay? Yep. By the way, there is a typo in the slide. Please fix it. It should be 10 because this is the amount of dividend we are paying at the end of the first year. We are paying 10 million for 1 million shares. What is the dividend per share? Is $10 per share. So present value of dividend 10 divided by 1.08. However, what did we prove from this example? Okay, what is the value of shares today? 62.5, right? And when it gives a dividend of 5 in the previous example, what was the value? Same things, right? 62.5. So that means we proved that even if you give more dividends today and less dividend later on, the value of the company will not change, right? It will remain the same. So we are proof in this example that just because you will give 10 million dividends, it will not increase the value of shares. It will still be the same. And that's what we are trying to prove. Again, the idea is that you will find the present value of 62.5. So there is no effect for dividends. Whether You pay high amount of dividends or low amount of dividends. Those guy M&M, they approved they are the same. Okay. Now, as I said, M&M, they said the amount of dividends will not affect the value. But here they assume we have efficient market. But in real life, we know dividends may increase the value. So this is the first scenario or one of the argument. Dividends may increase the value. Why? If we relax the assumptions of perfect market and efficient market, many investors claim dividends may actually increase value. Why? So those guys, as I said, M&M, they assume we don't have tax. We don't have many things. But in real life, we have it. If we relax those assumptions, that dividends will increase the value of the company. Why? Because dividends will attract natural clientele. It will leverage behavioral physiology. So this to you can consider as one point. So basically, the idea if you pay more dividends, there is some investor who like dividends. So you will attract them to the company. And once they buy the shares, there will be a demand on your share and the share price will go up and the value of the company will go up. So the first two are related to each other. Many people, they like dividends, they think of it as an income. Imagine if you have 100,000 shares and they distribute $1, you will have $100,000 every year. So you consider it as an income. Also, distributing dividends prevent managers from wasting funds. Before we learned sometimes managers they misuse the cash if they have too much cash, right? So it's better to distribute it. This will reduce the manager misbehavior. So this is like three reasons or two reasons why dividends may increase the value of the company. Also, dividends may reduce the value of the company. Why? If dividends are taxed more heavily than capital gains, a company that can convert dividends into capital gains should attract more investors. Okay, what is the idea here? In some countries, the tax on dividends is higher than the tax on capital gains. And when we say capital gains, this is the increases in the price. Like if you buy the shares today with $10, then the price goes up and you will sell it at $20. You will pay a tax, okay, on the profit, right? Like on the difference. Okay, let's give another example. If you bought the shares at $10 and you will sell it at $25, in this case, you make a profit $15 and you will pay tax on this profit. But the tax on the profit here, on the capital gain, will be less than the tax on the dividends. Most of the country always the tax on dividends is higher than the capital gains. Now, if this is the case, then as a visitor, I may like more capital gain, right? I don't like dividends. I receive dividends as a bad thing because they are going to tax me at a higher rate. All other things being equal, investors are willing to pay more for a stock whose returns come in the form of low tax capital gains. So if this is correct, then investor will be happy to pay more price for a stock that don't distribute dividends, but they use it in the growth of the company, and there will be a capital growth or increases in the prices. So sometimes this will attract investors who like the increases in the price. However, as I said here, most of countries they have these rules. Okay, dividends are taxed more than capital gain, right? But the last few years, I guess that some of the countries they make it the same, like tax on dividends is similar to capital gain. In US, they are different, similar to what I said before. On dividends is higher, but now there is this trend. They want to make it the same. Okay. Now, last slide, we will talk about the taxations, how this will affect us as a visitor and how affect corporations. One advantage to investor, capital gains taxes are deferrable. which means in some countries, if you make a profit because you sold the stock at a higher price, you're going to pay tax. But this tax, you can defer it in the future. There are some rules. We are not going through these rules, but there is some option you can defer the tax to different years. Okay, you defer it for futures. So this is one of the advantage for investors, for individual investors like me and you. One advantage to corporation is that if a company invests in other company, there are some advantage here. Corporations pay corporate income tax on only 30% of any dividends received from investment in other corporations. So if one company, like if company A invests in company B, okay, and they received money as a dividend, there are some rules. Sometimes you will be only taxed on 30% of your dividends, on only 30% of the income from dividends. Okay, so this is the same benefit sometimes for taxations. Okay, so this is all for this chapter. You can see there as many tiers and many topics. So please watch my video again. And if you have any questions, please post it in the Blackboard and I will answer it all, inshallah. All the best. Thank you very much. Wassalamu alaikum wa rahmatullah wa barakatuh.